So hi everyone, I'm Corey Reeder, Chief Investment Officer with HK Wealth Management, and welcome to our second quarter 2020 recap and market update. So all up, we're looking at about 38 minutes, so we try and keep these short and concise, get you the information you need, and then get you out the door and back on with your day. So starting off, so far we all know that unemployment has been skyrocketing, and including the additional initial claims report that came out this morning. Since March, there have been 52.7 million Americans that have filed for unemployment as of the week July 18. And there are 16.2 million that continue to file for unemployment claims. So continuing claims have dropped modestly, but it's hardly a signal that the reopening is accelerating. And if anything, I'm sure you've all seen in the news of late how everything is rolling over and starting to go in the other direction again, including the fact that today's initial unemployment claims was higher this week than last week. So it looks like we're starting to have a turn and an increase in weekly claims. But still, this is the Bureau of Labor Statistics that puts out these numbers. So actually, when you actually look into what the BLS does, this is a quote. We have repeatedly reminded that the BLS does not arrive at its jobs and unemployment numbers by counting. It generates them by modeling. And when the economy is at a big inflection point, to say nothing of the unprecedented turmoil of the moment, its models are not worth the digital ink they're printed on. Stated differently, it does make a difference that 15.2 million workers who are no longer on the job are not accounted for in the BLS monthly jobs report. The real unemployment rate is 21% and headed higher. So when looking at this is what the continuing claims report showed from the BLS on that last screen. When you count in all the unaccounted for unemployed people, continuing claims are actually sitting at 32 million thereabouts. A much different picture, and obviously a much worse picture than what everyone's being told. So moving on. A reason for the continuing unemployment claims being so high is when you look at the total job openings. So you look back here, this was the downturn after the dot-com crash. This was the downturn in 2008. Now you'll notice in the last couple of updates that I did, we were already pointing to the fact that this chart was rolling over and the job openings were already declining before the start of this year. And obviously we had a large drop with the pandemic that hit and is still going on and resurging as we speak. But you'll also notice in each of these other drops that there were these little upticks and then a continuation and a decline further to the downside. So just because we're seeing a little inflection point here with initial claims continuing to increase and more businesses going out of business, then this total job openings chart will continue to decline as we move forward. And currently there are 3.9 unemployed workers for every job opening, despite some of these record hiring surges in some of the government statistics on jobs. Now looking at, because you have all these businesses that are going bankrupt and going out of business and locking down or shutting down permanently, that also means there are permanent job losses that need to be factored in and thought about. And what you'll see, this orange line is an inverted chart of the permanent job losses. And you'll see permanent job loss is a consumption killer, something that the stock market in the past has sold on. Though the Fed's aggressive balance sheet expansion has suspended stocks at record high valuations, this manipulation cannot last forever as the economy is likely to stumble into a multi-year downturn. You'll see the dot-com crash with all the jobs that were permanently lost. Markets declined with them. Again, in 2008, they went in sync. What's happened so far is we've had all these jobs that have permanently lost, while at the same time, markets have skyrocketed higher on all this ridiculous amount of central bank liquidity. Remember, the Fed injected $3 trillion worth of liquidity at the bottom in March, and the federal government doled out $4 to $5 trillion of fiscal stimulus or government spending. So that's $7 to $8 trillion just to get this stick saved. But as you're going to see, the economy is anything but a V-shaped recovery. So looking at the recent periods of recession since World War II, all these different lines are going back to each recession that we had over the period. But what you need to focus on here is as of 1981, this pink line. Note that the last 4 recessions required longer periods consecutively for jobs to fully recover. The amount of non-productive debt used to combat downturns compounds the pre-existing debt problem that's already in the system. It ensures that the economy will continue to struggle for years to get back to the pre-COVID levels of economic activity. So here was 1980, 1990, 2001, it took twice as long. Stepping out to here, it's almost twice as long again when we had the 2008 downturn. So now when you look at the 2020 situation and the extrapolated return for that, you're going to be out here somewhere. So this is why I've been telling people for a long time that I was looking for a 1929 style crash and 30 style global depression that is still on point to play out the way things have been going. But, talking about debt, this is why. When you look just on the more recent period from 2005, Obama took over in 2008 and the total national debt was $1 trillion. Then by the time he left office in 16, it was at 20 trillion. Now, since Trump took over, it's gone up to almost 27 trillion. So say what you want about politics, but to me, it doesn't matter who the president is. They're all doing the same thing, is increasing the total national debt. That piper needs to be paid at some point. But looking back over longer term to 1990, you see how this debt has just been on an exponential rise over this time. And this is exactly why. This is just government level. Think about corporations levering up at this point in time too, trying to save themselves from the crisis that's going on. This is why it takes so much more longer. Debt is an economic killer. And that's why these recoveries take longer and longer each time to really get back to where they once were. Now, looking at more of on the microeconomic arena. So looking at the University of Michigan Consumer Sentiment Index. So this is consumer sentiment. It plunged in March. Yeah, we had that initial jump. But what happened on the last report? All 3 of these measures, this is all consumer expectations, current economic conditions, and consumer sentiment. And all 3 of them have rolled over, and there's a good reason why, because we're seeing a resurgence of the coronavirus once again, as was to be expected. Now, when you look at how this is going to be impacting the economy, so US consumer foot traffic coming up through, June is when everything peaked, and you see all of these. Casual dining has rolled over heavily, malls have rolled over heavily. Big box retail, Amazon and such, they've done much better, obviously, because everyone's ordering online, but even auto dealers had a good rebound. Why? Because everyone and their dog is running out to buy used cars because no one wants to travel on public transportation anymore. So this is a one-off adjustment right here as people try to exit the transportation sector and get in their own closed-off vehicles to try and stay protected. But everything's rolling over and turning down. Now, looking at bigger economic signals and indicators, for the 3rd straight month, US producer prices have deflated on a year-over-year basis in June. Against expectations of a 0.2% decline, they actually fell 0.8. So once again, the drop, the rebound, and this was also tapering and rolling over as we speak. Moving on to the rebound in US factory orders disappoints. Ended up being a lot lower than what they were actually expecting, but 2008 was an anomaly with a straight line down and a straight line back, but that was flushing out the economic cycle. Right now, they're trying to keep the economic cycle at its all-time peak as far as stock markets, and instead of companies de-levering on debt, they're increasing debt and bond issuance and everything else. So it's a totally different situation that we're dealing with compared to back in 2008. Now, when it's US total industrial production, so the recent bottom on this actually fell lower than what happened in the great financial crisis. But look at the headline: depression-like crisis unfolding with no V-shaped recovery until 2023. UCLA's Anderson School of Business warns. So, all these things are still pointing to the same outcome and nothing here at all positive for markets. United Airlines defers plane deliveries to beyond 2022 as air travel remains muted. 2019, this is where average traveler levels were. Of course, we had the drop and no recovery to speak of. This is the L-shaped recovery type thing that is now going to be playing out across all other economic sectors as well. As we move, there's so many more. barely scratching the surface of everything that still needs on the pipeline and all the economic knock-on effects that we still haven't even seen yet. Now, moving into real estate, what you'll see here is, and take this for perspective, 10.34 was the last peak overall. All these categories combined together, total delinquencies were about 10.5% in 2012, at the worst of the real estate crisis back then. Where are things today? Accommodation, hotels and vacation destinations, 24% delinquency rates. Retail, obviously no one's been out shopping, the consumers have been hunkered down at home, so all your brick and mortar places are sitting at about 18% delinquency rates. Down here, you have your multifamily, residential type things. So this looks very subdued compared to these other three, or at least these other two sectors up here. But when you look at the current to 30-day transition rate, so in April, the share of all mortgages that were past due, but less than 30 days past due, soared to 3.4% of all mortgages. That's the highest in data going back to 1999. So this was up from 0.7 in April last year, but during the housing bust, this rate peaked in November of 08 at 2%, and we're twice as high as that right now. So obviously there are government programs forbearing people's mortgages and rent and everything, but remember, to my knowledge, and from everyone that has talked about this, they say that all that back pay that people aren't paying now is just getting deferred. So in the future, somehow people are going to have to claw together enough money to not only pay their normal mortgage, but also pay back the rents and mortgages that they haven't been paying now for the last few months. Now, looking at overall US commercial bank loan delinquency rate, and this is correlated to the unemployment rate. And remember, this is the official Bureau of Labor and Statistics numbers. On that other chart earlier, we showed that the real unemployment rate is at 21%, somewhere up here. But yes, we know the world was in a similar situation in 2008, but with over 100 trillion more in debt today, knows how many additional hundreds of trillions of dollars in derivatives, plus a world economy disintegrating, it is now exponentially worse from a point of view. Just look at the chart below, how bad debts follow unemployment. The banks haven't reported this yet, but we will see it in the next couple of quarters. Now, this was a little older article, but then the most recent one that was speaking to the same thing, this same topic, said the biblical default wave arrives. Here's the avalanche of bankruptcies unleashed by coronavirus. So I'm sure you've all seen in the news countless companies after company that are all announcing bankruptcy and going out of business. And for all of you who know any sort of bankruptcy attorneys out there who had slim pickings for so long, now it's their turn to make hay while the sun shines, and they're overburdened with work. They just can't, they can't handle all the work that's coming through the door. So if all these, jumps in delinquency rates follow unemployment, where do you think the total delinquency rates would go? Up over 10%? It's probably expected it's going to go much higher, at least, than where it was in 2009, 2010. So, but what are the banks expecting? So looking here, the same quote that I took the last title from, so they went on to say in a different report, once again, we were right, because as the first three reporting banks revealed today, which was just a few days ago, the economic situation, as observed by the same banks that have a bird's eye view over the economy and what is coming, in the form of non-payment of their existing loans, is about to get far worse. As shown in the chart below, Q2 loss provisions surged from Q1, just as we said they would. And what this is the amount of money banks are putting aside to cover all those delinquent loans and bankrupt loans that these companies going out of business are not going to repay. And you'll see in just 2 months, they have already met or exceeded the peak of the great financial crisis. And once again, we're still just scratching the surface on what is still yet to come. So this is a real eye-opener for people to understand. Banks have their finger on the pulse of the financial system, right? And if they're setting aside and preparing for obviously much worse things to come, then shouldn't the rest of us? But anyway, moving on to federal government receipts. So these are your tax receipts that the federal government's bringing in. And just looking on a historical basis, obviously, you know, we're sitting down here at negative 8.3% on a year-over-year decrease. But if everything else plays out as we're expecting, then we would also expect these governments to continue to decline. And now I'm a chartist and a technician, you know, as far as a lot of what I do with management of investments. But if we just, you know, get a continuation line running from here, it's kind of funny that each one of these dips gets worse and worse as we progress. So could we possibly end up down here at maybe negative 25% on actual government receipts from people? Well, if we really go into a depression and things really do get as bad as everything seems to be foretelling that they will, then absolutely we can get down to those levels down here. So looking at global capex, now this serves as a guide, or better yet a warning, that US corporate profits will continue to fall. So the black line, so capex, that's your capital expenditures by these big global companies. And now as economies are growing and things are better, they pump a lot of money into investments and infrastructure and build out their companies to grab a hold of the wonderful economic times. When you go into a recession or depression, they dramatically slash their expenditure because one, they're not making any money anytime soon, and two, for that same reason, why are they going to expand their business if the economy and else is actually going tailspin and a nosedive? As you'll notice, every other time you'll see the blue line is US corporate profits, and it runs tick for tick with global capex expenditures. So obviously corporate earnings are going to continue to plunge lower as well. So overall, looking at leading economic indicators, so the culmination of all the economic indicators that can be found and they get compiled and aggregated, you'll see that this is where, once again, we got the drop and a little bit of a bounce. But one thing that can be said, if we lead, then this has a problem, obviously. So now, looking at what's going on with the unemployment numbers where they are and companies down and people losing their jobs, what this chart is showing is the yellow line is the compensation to employees. And obviously, when you hit a recession, those compensations drop because people lose their jobs and that no longer being paid out. This was the drop that has occurred so far in employee compensation. On the other hand, this is how much additional money the federal government has been pumping into people's pockets in the stimulus checks that they've been sending out. Not just that, it's the additional unemployment bonus of $600 per week, additional on top of their regular unemployment checks, which adds up to what, about $2,700 a month. However, they are slated to stop at the end of July. But with all this extra money, what have people been doing with this extra money? So over the past 3 months, US consumers have paid down a staggering $104 billion in credit card debt, which is just bringing it back to around the peaks where it was in 2008, when that all unfolded. But think about that. People, this economy is 73% consumer driven. And if these consumers that are now employed, that are getting this additional money, if they're not going out and buying stuff, then it's because they are actually paying down their debt. They see what's coming and they've got this infusion of cash, and a lot of them are just trying to pay down debt and get out from underneath the hammer, you know, as much as they can. But there's only so many ways you can split a dollar, and people paying down debt means that people are not out spending that money in the economy. Consumers don't consume, then there is no economy. Where else that money has been flowing to, as I stated in the invite to this update, was Robinhooders to the rescue. So over the most recent numbers I saw, probably this has gone much higher, but 800 new Robinhood accounts were opened up over a period from back when everything started to go pear-shaped in February. You account $2,700 a month by 800,000 new Robinhood accounts. That's almost $2 billion per month of cash that had been flowing into people's hands. Now, we did see that some of that money went towards paying down debt. However, you look at what else these been doing with this money has been opening up gambling accounts in the stock markets. You've got a lot of millennials and even kids as young as 12 and 14 open up Robinhood accounts and day trading. And you'll see the exponential explosion of Robinhood accounts in different holdings, but the famous in the first one of these was when a whole bunch of Robinhood traders jumped into bankrupt Hertz company. When a company goes bankrupt, that means you get an on you, and yet these people were jumping in and buying the stock up, when it was headed for bankruptcy, and then ultimately when it declared bankruptcy, they even increased their holdings. So this one right here is CBL, a properties, a real company going bankrupt. You'll see what Robinhooders did as the stock plunged, because they've been trained over the years, buy the dip, buy anything that's been beaten down. The central banks got our back and they won't let any of us lose any money. Well, that's far from the truth. But you can go on, you can look at the world's largest producer of small gasoline engines, files for bankruptcy. Here's your Robinhood trading accounts that have been piling into it. And if you're wondering, has been shooting to the moon and going parabolically vertical. Here, this is the green number of Robinhood trade accounts. Is they don't understand risk. It's all they see is momentum and something higher, and they pile in higher and higher, which is what's created the same euphoria, or even worse euphoria today in markets than what happened back in the dot-com bubble. But anyway, so if you want to take a picture, what this is showing, these are all the different car manufacturing companies. The red line is Tesla, but you've got Daimler, Volkswagen, General Motors, Ford, they're all hanging out down here. Up here, this is Toyota Motors. The red line, this is Tesla. It's been all the US car manufacturers combined, and it's even below Toyota. And put that in perspective, $500,000, 500,000 cars a year. Toyota sells $10.5 million cars a year. You think Tesla's market value makes sense? No, and it'll eventually come down just as quick as it went up, because that's what bubbles do. So I've had a lot of people ask me, do you think Tesla's a good buy? I'll let this chart speak for itself. So with some of the headlines that have been going on out there, more than half of the US population are working, million Americans, or 50 million Americans lost their jobs over 18 weeks. 42 million unemployed, 25.5% unemployment rate, 52% of small businesses expected to be out of business within 6 months. 53% of restaurants closed amid the coronavirus have shuttered permanently. Once again, there's some of your permanent job losses. US retail, over 25,000 stores could close by year end. And the last and the best, don't get greedy. Mark Cuban warns that the market looks like the 90s dot-com bubble. And remember, he was famous for cashing out his billions and billions of dollars by selling his company before the dot-com bubble fell apart, pardon me. So anyway, and there's more of these headlines along the way that are still coming, but we should at least consider the possibility of them falling out and prepare accordingly. So looking at where markets are compared to, so this is the Dow Jones recovery that's occurred. However, when you look at the 12-month Dow Jones earning estimates, generally they track pretty close to each other. However, this is a complete disconnect from any form of economic reality or business basis that's going on in the Dow. When you look at the NASDAQ, comparing it to a different metric, bond yields. So when things are falling apart, to buy US Treasury bonds because they're the safe haven. As people buy bonds, the price up, which the yield on the bond goes down. That's why when you see markets crash, you also see yields on bonds decline. However, bonds are not something this reality, this false sense of reality the stock market has engaged in, because bond yields have not increased with this huge disconnect between term bond traders and short-term stock jockeys and Robinhood traders. When you look at the NASDAQ, it's the broad US markets, and this is actually the metric that we gauge ourselves against. Broadly diversified, equally weighted as per Wall Street sales pitch. That's how average investors should be invested. So what this means is there is no breadth, there is no conforming trend that some of these major indexes, technology especially, are taking off and leaving the rest of it completely behind. The disconnects, this adds additional to these highs, bring them back down to earth. Think of this. Now, looking at a total price perspective or valuation metric, the NASDAQ compared to the small cap stock index, we're right back at where we were in the dot-com bubbles, dot-com bubble back in 2000. When you look at the NASDAQ compared to the S&P 500, what do you see? Wow, we've actually seen a new all-time high in this valuation metric of how overvalued tech is, even compared to the S&P, of which tech makes, the 5 big companies make up almost 85% of the performance in S&P. So here's a chart purely of the NASDAQ, and I call it the NASDAQ bubble 4.0. Back in 2000, we had the bubble. This was 2007, and then the real estate crash. Now, why I call it the NASDAQ bubble 4.0, you got bubble 2 here in the crash in 2018, bubble 3 and the crash in February, and bubble 4. This has gone, once again, parabolically vertical. Please, anyone, show me a chart where it rises parabolically has actually been sustainable to maintain those sorts of highs. Never happened and will. This is euphoria and a blow off top that we're experiencing as we speak. Now, why are these sorts of things occurring? Now, remember, we said the Fed added $3 trillion to their balance sheet, about $4 trillion to $7 trillion. And how the curvature and performance of the S&P has aligned with the Fed's balance sheet itself. That's all it's about, is Fed liquidity. Without the Fed pumping money, there is no market. But don't take this chart for proof. How about looking at, this is from the Federal Reserve's website itself, and that's up from $4 to $7 trillion of increased liquidity in the market. You do see that this has started to fall and decline, and this is a lot of reason why the S&P is sort of stalled out, and the Dow Jones and small caps and financials. There are a lot of other reasons as well, but the Fed stopped pumping money into the markets. When you look at it on a longer term, going back to 2008, this was QE1 and then QE2, Operation Twist, QE3, Infinity, QE, and I guess this one's QE to Infinity and beyond. But back September of 2019, last year, we noticed this increase in the Fed's balance sheet. And what a lot of people aren't aware of was there was an overnight repo market funding crisis. And that's in the overnight markets, that's where banks lend money to each other on a short-term overnight basis. Banks lending to each other. About the free of the market, banks don't even trust each other for an overnight period, and they're not sure they're going to get their money back. So the Fed had to step in and start pumping money to stave off that crisis. And then we've had this recent injection. As you see, this is rolling over now. Think about that. The common mantra out there is that cannot go down while the Fed is being accommodated and liquidity. Well, this chart shows that the Fed was increasing their balance sheet and being accommodative, and then everything still went pear-shaped in February while the Fed was providing liquidity. All that says to me is that after such a long time, cracks and starting to show in the armor of the Fed, and the fact that they are not omnipresent, or whatever the vocabulary word would be, they control markets forever, and they control right here with an increasing balance sheet and a market collapsing on itself. So buyer beware that if it's believing that the Fed will always save the day. You remember law of diminishing returns. At some point, and get no bang for your buck. Here are a couple of market events that we can look at as historic similarities to where things are. This one, once again, talking about bad breath, when major indexes are going up, but the broad markets are not being included in that run. I'm sorry, just a second. My apologies. I've got two 2-year-olds, a bulldog and a German shepherd, out in the living room. But still, when the S&P closed up 0.5%, and within 12% of the 52 high, while the New York Stock Exchange, the broad market, closed down, you'll see that the previous occurrences of this occurred at very not normal periods of time. And what the consequences of what happened. Sure, we had some smaller pulls sometimes, but the majority of them are occurring at major market peaks, and this is the last one that occurred. While looking at the NASDAQ compared with the Russell 2000, which is just small cap stocks. Once again, the most recent peak in the dot-com bubble compared to what happened just now. I mean, small caps are included in this current run-up. So then, is this a turning point in NASDAQ? So on July 13th, the NASDAQ 100 rallied more than 2% to set an all-time high, then reversed to close down by more than 1%. And as Sentiment Trader on Twitter notes, it's only done that twice. Today was one of them. The previous one was at the peak of the dot-com bubble, and that happened on July 13th. I mean, this is a small sample, but if it's an indicator, seeing that the point of the reason is that these are all flags keep building upon themselves. When people on Wall Street say, oh, who could have possibly seen that coming? If you really pay attention and start to add up all the red flags, the warning bells, that in itself becomes a weight and sort of a direction finder as far as where markets more than likely are headed moving forward. And so with all these Robinhood traders that have been jumping into US stocks, who's been the sellers of all these? So this was actually from Goldman Sachs, a report that they put out, net US equity futures positions. You know, the majority of US investors have been selling out of US stocks while Robinhood is jumping in. You know, the young kids, basically they said they see a ghost of a dot-com bubble as baby boomers sell stocks to their own kids. You know, you got the old guard with the experience and been through many economic cycles, and you got the young bucks who have never even seen anything outside of a video game for some of them. Sure, there are people that are astute and they do their research and reading and learn, but still, with casinos being shut down with the coronavirus, a lot of professional gamblers have turned to the stock markets as the only form of filling their gambling addictions as well. These are news stories out there. So what are the big corporate executives doing? What they're doing is, when it comes to market flow red flags, aggressive selling of stock by corporate insiders is traditionally viewed as the biggest advance alert. After all, nobody knows the price of their companies better than the people who run them, followed closely by the companies selling their own stock themselves. In which case it's red flags, because the following chart from Goldman's head of European sales, Mark Wilson, shows companies haven't sold this much stock in a single quarter in, well, forever. This is a massive amount of insider selling that is going on right now. There's a reason why they're doing that, trying to cash out at these all-time highs. So back in April, when I did my Q1, first quarter market update, what I stated back then was that, more specifically, since the beginning of March, I've been telling people that in my view, the S&P 500 could very easily drop to around the 1300 level. And then I also posted a quote from Scotland, who is Guggenheim's head of investments, where he himself said everything's being propped up by liquidity and the S&P could reach 15, 16, or even 1200. Now, why would I make such an outrageous claim, or even why would he? Well, when you look at what this chart shows, and I showed this in many updates before, the blue line is your S&P 500 index. The orange line is corporate profits. You'll see the dot-com bubble disconnect, and then the reconnect in the markets and corporate profits. And then they rolled over together in 2008. Markets have screamed higher on the back of Fed liquidity. What have corporate profits been doing since 2012 up until recently? Nothing. They've been going sideways with a total disconnect from reality. However, where have corporate profits now currently dropped back to? You guessed it, at 1200 to 1300 level. So if history and reality is any means to go by, and these two indexes do reconnect, then obviously it's stock market's touching down to really very real potential, because if the economy continues to fall apart and profits continue to decline, as we've already talked about, exactly where could profits and, in essence, where could the market finally end up residing? That's a heavy question to dwell. But, you know, the Fed knows. Just recently on July 15th, Reserve Vice Chairman Quarles is saying, we're seeing significant pricing disconnect between the market and economic fundamentals, which could result in sudden and sharp repricing. Buyer beware seems to be an appropriate slogan right here, because if the Federal Reserve themselves are saying that everything's disconnected and there could be a sudden repricing, you know, I thought that was supposed to be the be all and end all of cheerleaders, but I guess reality will speak out in the end. So looking at where we are right now, we're in the third week of July, and just for fun's sake, looking back at other periods, other years in the third week of July, this is a quote, finally we note that it's that time of year again, the third week in July, when things have historically gone a little bit turbo. In 2015, from the third week of July, ended up going down 12.5. In 2011, dropped 18%. In 2011, in 1999, it dropped 10, and in 1998, it dropped 21. So doesn't mean that it's going to again, but you know, why not take a look at other periods of time and see what potential outcomes could come. Oh, and by the way, if you've noticed in the markets today, something terrible has happened in the markets. All three, S&P, NASDAQ, and the Dow Jones, were all actually red today. How can that possibly be allowed? That's not supposed to happen in markets. I thought they only do one thing, is go higher forever, but now we'll see how it all plays out. So looking at this red line, this is a stock market analog. The red line is the Dow Jones in 1929. It had the initial crash and then a rebound and then a drop and then a drop and then a drop, coming until 1932. And then moving forward for the next 6 to 8 years, it just bounced and floundered sideways. So that was the crash and then the 1930s depression. Right now, here was that 1929 style crash that I was predicting and came through. Now we've had this massive rally. There's this now with the reemergence of coronavirus and the downward turning now in economic indicators and everything. Is this now the market's got, and do we now turn and follow a analog from 1932? Yep, analogs aren't predictive measures. It's just, once again, it's something comparative about what could potentially happen because it has happened in the past, which means it can happen again. But we'll have to wait and see if it plays out as such. One final thing to think about. So from Goldman Sachs, just this week, they put out their own NASDAQ Fear to Greed Index. When the index is in the red, people are fearful and they're selling stocks. When it's in the green, this is the euphoria and the greed. And a lot of times in normal markets, they stick to these principles. However, this is the common bubble blow off of greed that was in the market. Now, look where we are today. Almost twice as high as where we were in the dot-com bubble. And you'll also notice that each of these recent swings, do you see, getting more and more extreme and more parabolic in both directions? So when this one blows off and reality comes that everything is completely different from fundamentals, I have a strong gut feeling that the next downturn could be magnitudes worse than what happened in in March. With how quick the selling came, because when there's no floor on the markets, when that trap door opens up, fall apart, real saying. When everyone else is fearful, you should be greedy. But when everyone else is greedy, you should be fearful. And that's a saying that's held true through all markets. Now, just this morning, here are a couple of headlines that just across the news wires this morning. The Baltic Index, which is your global shipping index, has rolled over and is back to a 1-month low as rebound hopes fade. Bill Blaine, liquidity is blinding idiots to dangerous reality. Bubbles are far more dangerous when they are fueled by debt, which is what this one is. Avoid the stock, Goldman says. Apple's recent stock performance is unsustainable. The jobless claims reaccelerate, as we already talked about. Currently, Apple, Amazon, and Microsoft make up more than 16% of the S&P 500 index and over 1/3 of the NASDAQ index. So it's not just the S&P that is market cap weighted and concentrated on a couple of big tech names. The actual NASDAQ index itself is being pulled up by 3 big names. Once again, parabolic, unsustainable. Just today, Mnuchin announced that Republicans are proposing to reduce that extra unemployment bonus that everyone's been from $2,400 or $2,700 a month down to $400 a month. Well, poof, there goes all that Robinhood gambling cash out there. As you know, the double dip recession or depression comes along, they're not, you know, and markets actually, when they do and they all lose them they threw in there, times are going to be a lot rougher for them. Here's the New York Fed's weekly economic in course, showing high frequency economic indicators are turning down again. And Mnuchin also announced that there'll be no payroll tax cut as far as the new stimulus package or bill that they're trying to push through right now is obviously not beneficial to companies to not get that tax cut that was being priced in and being expected. So that's sort of where things stand and where we're headed. Nothing's looking too good as far as how we've been doing. So since August of 2017 up until today, once again, I said, this is that broad US market in value line, which represents your average investor's portfolio. From start to finish, our conservative fund is up 11%, while the broad index is down 15.5%. So it's beating by 27%. Protect from the losses and the drag downs. Our moderate global opportunity fund is beating US markets by 22.5%. Our US equity fund from August 2018, we protected from the crash of 18, and then we protected from the crash in March. So US equity fund versus broad US equity index, we're beating by 34% by protecting from the losses. The international equity fund is beating by 25%. So you see in the same, no matter which fund it is, they're all protected the same way on our regular investment funds. Our long short fund had a stellar performance when markets collapsed, but I've had this crazy and things in the major indexes, and so it's been pulling back. However, we did lever heavily here recently. So the market does give up the ghost. This turnaround and this outperformance will be more pronounced than we saw in the performance here because we have about 3 times more leverage on the shorts than we did during this period. And then finally, there are 3 new specialty funds that we added as of June 1st. We have a managed S&P 500 fund. We have a precious metals fund, which has been screaming higher over the last couple of days. All these charts are as of Friday 17th last week. But precious metals is screaming higher, and also Bitcoin is starting to turn the corner and it's heading higher as well. But these 3 funds are also using that basic downside protection mechanism that the 4 main ones at the top do. The only one is the long short fund, which by its contrarian nature, we try to use the underlying strategy, but there's a lot more open for interpretation as far as what's truly going on out there. So this is sort of our anywhere fund. So that concludes it for, well, you can see the information here. So you have my email address there, my cell phone number, and of course our website is there. If you want to see, if you want to share this webinar with friends or family or anyone, it will be posted on our website under our blog tab, along with all the other market updates we've done. And then on the funds tab is where you will see those performance graphs for the different funds that get updated on a weekly basis. So thank you all for attending. Hopefully this has been beneficial and informative to you, and that it'll help you out as we move forward through these troubled markets and troubled economy. Feel free to reach out with me about anything. Take care. Talk to you again soon.